Welcome back to Finance 331 Applied Investments. We are going to introduce multi-asset class investments in this class preparation assignment. But first, we're going to review some of the terms and concepts that we've covered already. Also going to do a couple of short professional development videos. So let's get started. As a reminder, you can work ahead on an essay assignment that is due right after Thanksgiving called The Richest Man in Babylon. It's a book, it's a PDF file on Blackboard that you can look at, read. It's free. This is actually a picture of the very first edition of that almost 100 years ago by Mr. Clayson. Work ahead, that way you reduce your stress towards the end of the semester. And that's an essay assignment, so you read the book and then you do the essay as the instructions show. The entire assignment should probably take you somewhere between 3 to 5 hours or so. All right. Let's review a little bit. There are, of course, many investment terms and concepts you have to learn. If this is your first course in investments, you'll be learning a lot of that terminology. But realize this, as the class goes on, there are fewer and fewer new terms. We're basically starting to connect a lot of the dots as we proceed later into the course. And very big term is standard deviation as a measure of investment risk. Basically, if you take any set of data, in this case a set of daily annual returns, we ask how dispersed are those data points, in this case the returns, relative to the mean. If we have a very small standard deviation, then most of the returns are going to fall within a small range. But a large standard deviation is going to have returns that could be really negative and really positive and the like. And kind of a hint, the stock market has a large standard deviation. Correlation is an equally important statistical concept. We want to look for asset classes that are not perfectly correlated to each other. Unfortunately, stocks, almost all stock asset classes, are positively correlated to each other and positively correlated even to REITs over time. Commodities, it kind of varies depending on what time frame you're looking at. There used to be a negative correlation. There's more of a positive correlation to stocks now. Pretty much the only asset class that is not correlated, called non-correlated, is U.S. long-term bonds or cash. Positive correlation varies from plus 0.10 down to plus 0.4 or plus 0.03. It all depends on what finance textbook you're reading. You have negative correlation from minus 1 to minus 0.4 or minus 0.3. Again, that's called the correlation coefficient. And then we have not what are called non-correlated investments that are somewhere in between that. Modern portfolio theory. Basically, there's a lot to it, but for purposes of this class, what we're saying is that if we have two different assets or investments, and they don't have perfect positive correlations, and pretty much no investments have perfect positive correlation to each other, and if they have similar standard deviations, in other words, similar level of volatility, then we can reduce portfolio risk by mixing them in a portfolio. Now, there are times when you can add an asset class to several other asset classes, and that asset class has higher volatility to it, but if it has a fairly low correlation, you can actually reduce volatility or keep volatility as measured by standard deviation about the same. So you don't necessarily have to have similar standard deviations all the time. But you can certainly reduce portfolio risk and perhaps even increase returns by mixing them in a portfolio. And in fact, if we were to take several different assets and then do all the combinations of those, like 1% of this and 20% of that and 60% of this and 9% of another, that's going to be one of those dots if there were just four asset classes on this chart. And then we do all the different combinations. And what you end up with is, for that portfolio, what is the expected return of that portfolio? Of course, we have the expected returns of each asset or asset class. And then what is the standard deviation of that portfolio? That is one measure of risk. Right? And what we're trying to do is get to the northwest frontier over here, but we can't get beyond that line. All right, at least the theory goes. All right, and whatever portfolio we want to choose, we want to be along that line because we wouldn't want to have a return that has this type of standard deviation over 20% here, but have a lower return, lower expected return in this case. So if we're going to have that kind of standard deviation in our portfolio, that type of volatility, we want to go for what's along the line. So we want to go here, 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 somewhere in those ranges. All right. Again, we desire the greatest return for the same level of risk, or we desire the lowest level of risk for the same return. All right. So basically, these are the optimal portfolios, and this line is called the efficient frontier, and we would like to be up here towards the northwest quadrant of that. What are my favorite 4 words? Buy low, sell high. Yeah. And what's my favorite 1 word in investing? You should know it by now. Diversification, or diversify. Yes, the only free lunch in investing. When in doubt, diversify. That is a key to investing. Right? So anytime you have a doubt about whether you need to diversify, diversify. It's just a great thing to do. What are we diversifying among? Both asset classes and individual securities. Now, how many individual securities does it take to reduce basically what's called idiosyncratic risk or diversifiable risk? And actually what you see is by a lot of investment managers, portfolio managers, especially those associated with banks and trust companies for some reason, a lot of times they'll run portfolios that have like 30 or 40 stocks in it. And the theory is, hey, we reduce standard deviation here down to pretty much the standard deviation if we own the entire market, the entire stock market, all 3,700 US stocks, for example, all right, if we were just investing in US stocks, and we own them by market cap. So we basically own a lot more of Apple than we do of US airlines and things like that. So they basically posit that, you know what, 30 to 40 stocks is really what you need to get your standard deviation down there to reduce risk. But I think to reduce the impact on a portfolio of any single security's fall in value of 0, and to counter the statistical problem that only 30% of all the stocks in any index will outperform that index. So 30% of the US stocks in the S&P 500 index, a large company US stock index, outperforms the index itself, but 70% underperform. And the reason for that is there are some really big winners every year in the market, and those big winners add a lot to the returns. And because of that, if you just have a minimal amount of securities, the more less amount of securities that you have, the more likely it is that you're going to be excluding from that portfolio one of these really big unexpected winners out there. And therefore, you might as well just own the entire index, hundreds or even thousands of stocks. Yeah. And sometimes, just a few stocks drive the S&P 500 index up. As of July 19th, 2020, the largest 6 stocks in the S&P 500 index, Apple, Microsoft, Amazon, Alphabet, which is Google, Facebook, and Netflix, accounted for more than 1/4 of the value of the S&P 500 index. We haven't seen these large cap growth stocks, because of their valuations, get to be such a big valuation in the market until you go back really to the dot-com boom, when you had Microsoft and Intel and several other stocks that were not technology stocks but were considered growth stocks, like General Electric, that dominated the S&P 500 index. So a little bit of a worry there. And in fact, here in 2020, I read an article just a week ago, and it said that 10% of the stocks in the S&P 500 index are up this year, as of around August 1st. 90% of the stocks are down, even though overall the index is up slightly this year after recovering from March when the index went down. So, wow. What's an asset class? We have stocks, also called equities. We have bonds, also called fixed income investments, cash. Real estate is often regarded as the fourth major asset class. Some texts kind of say this is a alternative asset class. Some say it's one of the core asset classes. Commodities and hedge funds, and there's some other types of investments are also considered alternative investments, and we'll study those later. So, an asset class is a group of investments that have similar characteristics in terms of risk or return, perhaps their taxation, how their returns are taxed or something like that, where they might be located geographically, and the like. They are subject to similar market forces, laws, and regulations as well. So, what's riskier, a stock or a bond? Well, if either of these companies file bankruptcy, and by the way, Eastern Airlines did file bankruptcy a long time ago, used to be the largest airline in the U.S. Basically, when Eastern Airlines filed bankruptcy, bondholders got back something as all those planes and other assets of the company were sold off, but stockholders typically get zero, and in that case, they got zero as well. So basically, bonds are more risky. Stocks also, the value of stocks can go up and down dramatically. So if you look at risk in terms of volatility, the value of stocks are more volatile on an individual basis or even on a collective basis than bonds. So sometimes the recovery rates, the amount that bondholders get back will vary depending upon what type of lien position they have. For example, you might have what are called, let's see, this is a senior unsecured bond. You see the recovery rate 37.6%. That's kind of the typical recovery rate, 30 to 50%, 30 to 60% perhaps for most companies. But again, there are some companies that file bankruptcy and bondholders get very little or nothing because there's really no assets. That doesn't happen very often. But also there are companies that file bankruptcy sometimes, and there's a lot of assets, and maybe the recovery rate is higher for those. But typically, what I've seen, especially with larger companies file bankruptcy, is around 30 to 40% typical recovery rate. Maybe a little bit higher for some other companies. Now, most of the time, again, stockholders get zero when a corporation files its liquidation form of bankruptcy. But so stocks are risky. Corporate bonds have risk too. I mean, if you were to loan a company $1,000 and that company files bankruptcy, you want to get $300 to $500 back of your principal amount plus any interest that you may have been earned and paid out. Not very good. All right. So there are safer bonds. There are bonds backed by the full faith and credit of the U.S. government. What does full faith and credit mean? It means that if you own this bond and you turn it into the U.S. Treasury, you are going to get cash for it. You're going to get basically a Treasury note. It's called a dollar bill. All right. And in fact, your bonds won't default unless the entire U.S. government defaults. So, what's the chances that the U.S. government will actually default on its bonds? Pretty slim, the world thinks at this point. All right. But the U.S. government's got a lot of debt. We may have to explore that later. U.S. government agency bonds, some of those, like Small Business Administration bonds, are backed by the full faith and credit. Ginnie Mae, what are called Government National Mortgage Association. But others are not backed explicitly by the full faith and credit. An example is Fannie Mae notes and bills and bonds. Municipal bonds are backed by the revenues of their state and local governments. Now, there are municipalities that do file bankruptcy. States are not allowed to file bankruptcy, but towns and cities and other taxing districts like a toll authority can file a bankruptcy, and some do. One of the biggest was the city of Detroit filed bankruptcy several years ago. They're usually pretty rare, and we'll explore that later. Corporate bonds, of course, have more risk associated with it because a lot of corporations file bankruptcy. Gosh, just this morning, as I was preparing this, I found that Lord and Taylor filed bankruptcy and Men's Warehouse filed bankruptcy. More and more retailers, as we know, are filing bankruptcy because of the decreased sales here in the pandemic, but also because of this long-term trend to buying things online. Yeah. So now, just some reminders, some professional development activities we've kind of done or thought about. One is don't judge others. All right? Don't allow yourself to live a life in which you're judging others all the time. That's just not a good thing to do. Try to not judge others unless you're required by your job, for example, your supervisors, to do that. All right? Sleep is essential for success, both in college in terms of your grades and also just success throughout life. You get more sleep, you're more likely to be more engaged with other people, and you're likely to advance your career. And a lot of companies have recognized this. Self-control may be critical to your success. Your ability to exercise self-control. Basically, self-control means you're making decisions every day and you're saying, instead of going to a refrigerator, I am just going to drink a diet drink. All right? Instead of going out with friends tonight, I'm going to go ahead and get studying done for this exam that's 2 or 3 days away. Something like that. So, daily decisions. Basically, your self-control muscle isn't perfect. It's not perfect for everybody. But it is something you can strengthen, and the more you strengthen your self-control muscle, the better you use it. In forming teams, it's good to discern team member strengths, and there's a lot of research there about how do you effectively form teams. Some really good academic articles, but also some really good books about that and videos on YouTube, including a book by Sean Aker recently. Now, teams with all the people who are basically have the same type of personality, for example, they're all highly reliable. Those teams actually underperform teams that have more diverse personality types. Because sometimes there are people in a team that may not drive the conversation, but they may facilitate it, or they might be more creative, for example, like that. So, having a diverse set of personalities on a team can really help pay off. I just want to share with you a video for about 5 minutes here. I'll pull this up and expand it and play it.
When I was 27 years old, I left a very demanding job in management consulting for a job that was even more demanding, teaching. I went to teach 7th graders math in the New York City public schools. And like any teacher, I made quizzes and tests, I gave out homework assignments. When the work came back, I calculated grades. What struck me was that IQ was not the only difference between my best and my worst students. Some of my strongest performers did not have stratospheric IQ scores. Some of my smartest kids weren't doing so well. And that got me thinking. The kinds of things you need to learn in 7th grade math, sure, they're hard. Ratios, decimals, the area of a parallelogram. But these concepts are not impossible. And I was firmly convinced that every one of my students could learn the material if they worked hard and long enough. After several more years of teaching, I came to the conclusion that what we need in education is a much better understanding of students and learning from a motivational perspective, from a psychological perspective. In education, the one thing we know how to measure best is IQ. But what if doing well in school and in life depends on much more than your ability to learn quickly and easily? So I left the classroom and I went to graduate school to become a psychologist. I started studying kids and adults in all kinds of super challenging settings. And in every study, my question was, who is successful here and why? My research team and I went to West Point Military Academy. We tried to predict which cadets would stay in military training and which would drop out. We went to the National Spelling Bee and tried to predict which children would advance farthest in competition. We studied rookie teachers working in really tough neighborhoods, asking which teachers are still going to be here in teaching by the end of the school year. And of those, who will be the most effective at improving learning outcomes for their students? We partnered with private companies asking which of these salespeople is going to keep their jobs and who's going to earn the most money. In all those very different contexts, one characteristic emerged as a significant predictor of success. And it wasn't social intelligence, it wasn't good looks, physical health, and it wasn't IQ. It was grit. Grit is passion and perseverance for very long-term goals. Grit is having stamina. Grit is sticking with your future, day in, day out, not just for the week, not just for the month, but for years, and working really hard to make that future a reality. Grit is living life like it's a marathon, not a sprint. A few years ago, I started studying grit in the Chicago public schools. I asked thousands of high school juniors to take grit questionnaires, and then waited around more than a year to see who would graduate. Turns out that grittier kids were significantly more likely to graduate, even when I matched them on every characteristic I could measure, things like family income, standardized achievement test scores, even how safe kids felt when they were at school. So it's not just at West Point or the National Spelling Bee that grit matters, it's also in school, especially for kids at risk for dropping out. To me, the most shocking thing about grit is how little we know, how little science knows about building it. Every day, parents and teachers ask me, how do I build grit in kids? What do I do to teach kids a solid work ethic? How do I keep them motivated for the long run? The honest answer is, I don't know. What I do know is that talent doesn't make you gritty. Our data show very clearly that there are many talented individuals who simply do not follow through on their commitments. In fact, in our data, grit is usually unrelated or even inversely related to measures of talent. So far, the best idea I've heard about building grit in kids is something called growth mindset. This is an idea developed at Stanford University by Carol Dweck, and it is the belief that the ability to learn is not fixed, that it can change with your effort. Dr. Dweck has shown that when kids read and learn about the brain and how it changes and grows in response to challenge, they're much more likely to persevere when they fail because they don't believe that failure is a permanent condition. So growth mindset is a great idea for building grit, but we need more. And that's where I'm going to end my remarks, because that's where we are. That's the work that stands before us. We need to take our best ideas, our strongest intuitions, and we need to test them. We need to measure whether we've been successful, and we have to be willing to fail, to be wrong, to start over again with lessons learned. In other words, we need to be gritty about getting our kids grittier. Thank you.
And thank you, Angela. Yeah, very good. So, Angela Lee Duckworth, grit. If you want to explore grit more, I would recommend you research that on the web a little bit. Also, something called the growth mindset as well, and maybe even write about that, and maybe even expand your comfort zone exercise, because you can create your own exercises in this class for those assignments. All right, so let's get into this multi-asset class investments. And what's our framework for selecting investments? Well, we still need to come up with some terms. All right, here in the United States, there's a difference between large company stocks. Generally speaking, those greater than $10 billion in terms of the total value of the common stock. Mid-cap stocks, 2 to 10 billion, and small cap stocks are less than 2 billion. An example would be, just a real quick example, say a stock is trading at $40 a share and there are 2 million shares outstanding. That stock has an $80 million market cap, so that's definitely a small company or a small cap stock. Cap stands for capitalization. So mid capitalization, small capitalization. But the way you hear the term as being used by investment advisors and in the industry is large cap, mid cap, small cap, or large company, mid size company, small size company, something like that. The largest market caps as of July 20th: Apple, $1.71 trillion, Microsoft, Amazon close behind, and Google, which is now called Alphabet, 1.07 trillion. So we have four companies that are worth more than $1 trillion. Behind that is Facebook, I believe, somewhere around 600,000. Now, to actually see this, we can actually pull this up and see what are the largest stocks today. And we get a definition here. And where do we go? Here they go. There we go. And we see that the market cap has actually increased for Apple. All right. $1.8 trillion. Amazon, Microsoft, Alphabet, Facebook still there. Alibaba, which is kind of the Chinese Google, so to speak, I believe, is there. Berkshire Hathaway, Taiwan Semiconductor, Visa, Johnson and Johnson, and the like. Tesla, $266 billion, is worth more than Toyota at $167 billion. That says something right there. So a lot of big companies on this list, and you can pull up that list at any time and take a look at it. All right. So we can also group stocks by where the home office of the company is located, basically where they charted at. There are a lot of companies that have their home base here in the United States, but there are also a lot of companies like Toyota, home base in Japan, all right? Nestle, home base somewhere in Europe. Uh, so you have developed markets, which are basically the U.S. and Canada. There's kind of one market, and then we have foreign developed markets. Foreign developed markets are companies where they have strong accounting systems and their economies are basically mature. They have a strong financial system. They have a good manufacturing base. It's not Their economy is not all just tied to agriculture or exporting oil or gas or minerals typically, or agricultural products. Right? So they have kind of a mature. They also have good, strong political stability. Right? And then we have emerging markets. Now these are countries that are trying to transition to a modern economy, and they may be well along to it. There might be some political risk apparent, for example. Um, a good example of that might be Taiwan. All right. Taiwan has got a strong accounting system, it's got a very mature economy, but it's got a huge amount of political risk because China would like to invade it. Yeah, China would like to take it over. So it's actually classified on the most emerging markets index as an emerging markets country. Also, the rule of law is enforced most of the time. Basically, if you have a contractual right, including a right as a shareholder or a bondholder, you have the right to have that enforced through the courts. And that's the enforcement of the rule of law. Then we have frontier markets, which basically have a lot more risk associated with it. Now, if we look over to the right, we see that the U.S., all the publicly traded stocks in the U.S. accounted as of 2016 for about 53% of the markets. It's right around 50% now. All right. Next was Japan, United Kingdom, France, Germany, Canada, Switzerland, Australia, China, 2.2%. So even though China's economy is, by some measures, either equal or even exceeding the size of the U.S. economy, they don't have a lot of publicly traded stock in terms of the market cap of the stock, the market capitalization, the value of the publicly traded stock. All right. If we go back more than a decade to 1900 and we look at this, United Kingdom was the big leader at that point. USA, 15%, Germany, 13%, then France, Russia, and Austria, not showing up later, Belgium, Australia was still there, South Africa was there, Netherlands, Italy, and the like. So basically, countries' economies have grown and shrank, but also the value of the publicly traded stock has changed over time. If we were to look at this from a different perspective and ask, well, how much of the world's publicly traded wealth, if you are an investor and you invest in something called the global market portfolio, what are you investing in? 45% stocks from all around the world, right? 6% real estate, because most real estate is not publicly traded through what we see as what are called REITs primarily. And then we have different types of bonds, both government bonds issued by the United States or other countries, but also corporate bonds, 19%, and government bonds, which would also include like municipalities, states, and towns and the like. Commodities, only 1% of the total portfolio. Commodities being things like futures contracts in oil and gas and agricultural products and precious metals and the like. We have also seen a decline in the number of publicly traded stocks in the United States. As of July 2020, there were 3,745. So this peaked here right around the dot-com boom. I had a whole bunch of small companies going public here in the 1990s. And then ever since that, we've seen a lot less companies. And we have different data sets here that are measuring that. They overlap. All right. So it started off about 5,000 companies, but now it's down to 3,745. There are some reasons for that, and we'll be exploring those reasons. Now, as you read Chapter 4 of the Fairy Talks, you will find some key takeaway. Owning several asset classes is better than owning just a few. And you ought to kind of explore why. Why? Because each new and unique asset class can reduce portfolio risk. Right? So, good idea there. Multiple asset classes reduce risk and increase returns. Here is from Roger Gibson's book, Asset Allocation and the Rewards of Multiple Asset Class Investing. The original book, 1998, is now in its fifth edition, by the way. But he did a study and he basically combined portfolios of four different asset classes. One was U.S. stocks, the other was foreign stocks, C is real estate securities, and D was commodities. And he basically said, okay, let's put an equal amount in the different portfolios. You have two asset class portfolios. So, for example, U.S. stocks and foreign stocks, 50% each, or U.S. stocks and commodities, 50% each. Then you have three asset class portfolios. And then you had the four asset class portfolios, 25% each, U.S. stocks, non-U.S. stocks, real estate, and commodities. And if you had invested in just one of those asset classes, said, I think U.S. stocks are going to do really good, your return over this period of time would have been the lowest. Foreign stocks did better, commodities did better, but with a lot more volatility. Real estate turned out to be the best performing single asset class. But if you combine those portfolios, if you combine them into two, you see these triangles. If you combine them into three, you see these diamonds, these green diamonds. All right. You would have loved to have been here or here, depending on your risk level. All right. And then if you combined all four, you would have been there. So you would have had a lower risk as measured by standard deviation. Except for one portfolio, you would have had a higher return except for four of these other portfolios out of all of these that are here. So basically the benefits of diversifying. Why do you get these benefits? Because as values of these asset classes go up and down in value, as you rebalance, if something goes up in value, you sell some of it and you buy something that's gone down in value. It's basically forcing you to do what I really want you to do, which is buy low and sell high. Yeah. Rick Ferry also says you need to choose asset classes to possess these three characteristics. One is positive real returns, returns that are in excess of the rate of inflation. And we're going to ask ourselves when we review this, is this really true? because right now bond returns are really, really low. U.S. Treasury securities, the 10-year bond is down to like 0.54% today in terms of its interest rate that it pays, which is likely lower than the rate of inflation that we will see, which typically is going to run around 2%, might be a little bit lower over the next year or so. Low correlation to each other. All right, we know that. Why? Basically, it helps from the standpoint of rebalancing. Right? We don't want our portfolio to move all up and all down at the same time. We'd like to have a smoother ride, but you also need to be able to access the asset class cost efficiently, and that's one of the reasons we're going to rule out investing in, for example, hedge funds. Right? So again, should you always invest in asset classes that only possess real positive returns? The 10-year Treasury note was actually 0.59%, not 0.29%, but it's down to 0.54. AAA rated corporate bonds 1.48%. The inflation rate over the last year was 0.60%, so it was higher than the 10-year Treasury rate, higher than the U.S. Treasury one-year rate, which is about less than 0.2%. And inflation, although it's been really slow because of the pandemic, just looking back on January 20th, inflation was running at a 2.3% annual rate. So prices declined somewhat because of the pandemic in several areas. So if we look at the spread between 5-year AAA rated, these are highly rated U.S. corporate bonds, or foreign bonds, AAA rated, which means they're really, really not likely to default at all. And we compare that to the 5-year Treasury, we have a yield spread of 1.18% there. Pretty low yield spread. When we talk about a yield curve, how do we build a yield curve? All right. Basically, we plot out for the same bond, for example, a U.S. Treasury security or a U.S. corporate bond, if there's a lot of bonds that have been issued by that company, they have different maturities associated with them. And Treasury securities, they issue a whole bunch of 1 month, 3 month, 6 month, 1 year bonds, and those bonds issued 30-year bonds, they basically become 29-year bonds the next year and 28-year bonds and so forth. So we can look at the yield curve. Here's as of August 10th of 2020, when interest rates were higher than they are today, and we see a positive yield curve except right here. Yeah, we actually had a higher 1-year rate than we had than the 10-year rate. And when we have a higher short-term rate compared to the 10-year rate, that usually is an indication that a recession will happen. And in fact, we are in the middle of a big recession at this point. Usually it says a recession will happen within a year and a half, something like that on average. Now there are probably some reasons behind the recession that are related to the pandemic as opposed to kind of an economic downturn. We'll explore that later. A yield curve, so it plots these on a graph, so to speak. And when you do that, you end up with something like this. And this is as of July 20th. What we see is the current yield curve is pretty low. All right, you go out and buy a 1 month Treasury bill, you're basically getting just a little bit over 0%, about 0.1%. Getting a 30-year bond, you're only getting like 1.3, 1.4% interest. A year ago, interest rates were higher all across the U.S. Treasury yield curve. So that's what happens when you plot out all those numbers. Again, an inverted yield curve is when long-term rates fall below short-term rates, and that's an indication that a recession is likely to occur within the next, on average, about 18 months. Now, when you get into Chapter 5, basically a framework for investment selection, all right, he's basically stating a principle here that asset classes should be fundamentally different from each other. So I was actually an investment advisor back in 2007, 2008, 2009. Still am an investment advisor. But One of the things I did for fixed income investments is some of my clients' money were in what's called the Vanguard High Yield Corporate Bond Fund, which is really the most conservative of what we call junk bond or high yield bond funds. Basically, bonds issued by companies that have lower financial strength are more likely to default. All right? And what happened was when the stock market went down, high yield bond prices fell substantially. All right, sometimes even more than the stock market. Yeah. So even though bonds typically are kind of your anchor in your portfolio, we had clients that basically saw both their stock portfolio and part of their bond portfolio go down in value, and they weren't very happy about it. I did a 30-page report in March of 2009 explaining why high yield bond prices would go back up, and in fact, they did not too long after that. So here's actually a snapshot of the Vanguard High Yield Bond Fund. If you put $10,000 in it, it would have gone down to less than $7,500. So big drop, 25% drop. Not as big as a lot of the high yield bond funds because the Vanguard fund was more conservative, but it did rebound pretty quickly. And since then, it's done pretty well. Um, and the performance over this 10-year period of time from late 2007, which was right before the market crashed in 2008, 2009, all the way to 2017, was 7.11%, or 6.71% for this fund, for all of the indexes total of high yield bond funds, a little bit higher than that. So I didn't repeat that mistake. Uh, Here is a performance of the high yield bond fund earlier this year. This is for the past year through June 29th. And as we saw, basically $10,500 invested went down to around 89,300. So that bond fund lost somewhere around, we'll say 15% in value, something like that. Uh, so I did not have clients invested in the Vanguard High Yield Corporate Bond Fund this time. Treasuries are probably the best diversifier from the standpoint of looking at types of bond funds. Then certainly the best diversifiers when it comes to the stock market. When the market goes up in value, here are U.S. Treasuries. All right, what is the correlation of large company U.S. stocks as measured by the S&P 500, developed markets, emerging markets? A somewhat negative correlation. Typically, when the market goes up, the, the interest rates fall, and the value of long-term bonds goes up slightly. Yeah. So, U.S. Treasury securities are probably pretty much, in terms of fixed income, the best diversifier out there because they tend to do really good when stock markets get really ugly. Yeah. Another question that Rick Ferry asks is, can you access the asset class at low cost? Diversification usually involves purchasing by means of mutual funds. Basically, you put your cash in with other investors as a portfolio manager who goes out and buys a whole bunch of different stocks or a whole bunch of different bonds. There's also exchange traded funds, which is kind of a variation of mutual funds. We'll explore that. We're looking for low fee and cost mutual funds or exchange traded funds. All right. Cost matter. If you had a $100,000 portfolio and a 6% return, which was reinvested all the time, so you didn't take the money out, you just added to it. If you had zero cost involved, and it's not possible to invest with zero cost, but you end up with, after 30 years, that 100,000 would be 574,000. 2.25% annual cost, 532,000. 0.9% annual cost, which by the way is close to the average fees of the average mutual fund today, only 438,000. So you would have gained a lot more money by keeping your costs down. Fortunately, asset weighted average fees for funds have declined significantly for actively managed funds and also for passive funds or index funds. In fact, you can go out and buy S&P 500 index funds now for about 0.03% a year in terms of the fees that are charged. Now, there's some other costs relating to funds that we'll explore that are not reflected in that, what we call annual expense ratio. And fund fees often don't include financial advisor fees. So if you have a financial advisor who's managing a portfolio for you, let's say you have a $1 million portfolio, the average fee 1.02%. The more you have in your portfolio, the average fee goes down. I will say, however, that just over the last several years, fees have come down here. Probably this average at a million is like 0.85%, maybe 0.8%. This has come down substantially as well. But there's a big variance in financial advisor fees. I want to explore a short video. It's about 4 minutes. It's about procrastination. And let's listen.